What's going on, guys? Welcome back to the channel. In this video here, we're doing a stock analysis on Coca-Cola, probably the most American company, and as this episode airs, it's 4th of July, so happy 4th of July to all my American friends down south from your friendly Canadian investor up in the north. So, loading this company up in the stock research tool here, built by yours truly. If you want to get your hands on this software here, folks, stay tuned because it's coming out sooner than you think. This is just the beta version. So let's look at what's happening with Coca-Cola. So within my software here, we have this section here called the financial evaluations, where this piece of software looks at the balance sheets, the cash flow statements, as well as the income statements, and it grades it out of 10 based off certain parameters. So we'll go into those parameters, and just to let you guys know, we are ranking this company a 5 out of 10. Not that great. So what is Coca-Cola doing right, and what is Coca-Cola doing wrong? So the things that they are doing right, and we'll start off with the good first, is the return on equity average sitting at 34.96%. We want to see this number over 15%, folks, and we have that no problem. We also have a decently high EPS growth number that we're seeing over the last 5 years, so that's healthy to see, as well as our free cash flow has been growing, and our return on invested capital average is sitting well above 10%, sitting at that 14.34% mark. That is phenomenal to see here, folks. However, it does get a little bit sour as we move into the negatives. So just switching it back here, we do have 5 negatives here, and they're not that, correction, some of them are not that bad, but some of them are. Our 5-year PE average is sitting at 55.12. We'd like to buy companies that are sitting at 22.5. So that 55 number is pretty high. Our current ratio is sitting at 1.18. Now, I like seeing companies that have a current ratio sitting at 1.5 or higher. That means, or that indicates to us that they have enough assets on hand to cover the liabilities, plus some wiggle room with that 0.5. So in case something hits the fan, like shit hits the fan, you know, we go into a massive recession, no one's buying Coca-Cola, they're in so much debt, they can cover those liabilities, they have those assets on hand, and they won't get completely wiped out. 1.18 is the number that Coca-Cola has, and it's not that bad. It's not that bad of a number, folks, so I can be somewhat forgiving, but it's going to get no points from me in terms of this evaluation. And that's the reason why is because if you look at their debt to equity, take a look at this number, folks. It is absolutely horrendous, sitting at 165%. For the record, we want to see companies sitting below 50%, folks, below 50%. What they're doing here, folks, is that they are growing this business through debt and not through equity. I don't like when companies do this, because then afterwards their creditors have this strong hold on this business, and then they eventually, what will happen is that they get into this loop of, we got to take on debt to pay off more debt, take on debt to pay off more debt. And we'll talk about this in Coca-Cola, because if we go into the company metrics category for just a quick second, our dividend yield is sitting at 2.67%. Our dividends paid is $7.3 billion. Our 5-year average free cash flow is $8 billion, folks. This is worrisome, and I don't like that. That means $700 million on average is left over to continue operations within the business. Is that what you're telling me here, folks, Coca-Cola? Is that what you're telling me? That we pay off so many dividends, so much money in dividends, we have $700 million to figure out what we can do with the company? So what do? They take on debt because they have to. They have to uphold that dividend. They have to be that dividend aristocrat or dividend king at this point, where they constantly, every single year, up the dividends being paid out in terms of payment. Listen, and that's why people buy this company. This was the first American company that I have ever bought in. I bought it off the premise that Warren Buffett likes this business. Obviously, I'm finding out, oh, Warren Buffett's a huge fan of this company too? Sure, let me just jump in and buy this thing. And also the dividend helped too, and because I was such a huge fan, I'm like, oh yeah, dividends. Anyways, enough of my rambling. This is the first American company that I bought, so it has a place in my heart. But I don't like seeing how much debt this business has been taking on. Along with, they have slightly been diluting shareholders. 0.93% is not the worst, but we want to see companies either decreasing the amount of shares that are outstanding by buying them back, or at the very least staying the same. So they're taking on massive debt, they're diluting you, and technically, their revenue growth is actually lower from 5 years ago. My thoughts on Coca-Cola right now. Would I buy this company based off of what I'm seeing so far? Well, I have to still do a price analysis to determine what a fair price to pay for Coca-Cola would be. However, this 5 out of 10 score is a little bit dicey. I don't like the PE average being so high, as well as the debt to equity ratio is a huge red flag for me, as well as even though it's a small decrease, the small decrease in revenue, it has me concerned. But the main thing that's bothering me and what attracts a lot of people to this company is how much we're paying out to dividends. Granted, this is a huge business and they're not focused on growth. They're not focused on growing anymore. They're happy at where they are. So they're playing this dividend game, give back to the shareholders. So a lot of people will just hold it for that. I don't like when companies put so much of their free cash flow towards dividends. And they've dug themselves a hole. This is the bed that they made. Sleep in it if that's the case. We're going to go into a price analysis. So this is the section of my software here where we're able to put in 3 different styles of assumptions: conservative, moderate, and aggressive. And we can price out what we believe this company is going to do over the next, let's do 10 years. We'll do 10 years there, folks. So I'm going to fill out those boxes, and then we'll touch base with just a quick second. All right, folks, so here's what I did. With my revenue growth numbers, I took a different approach. I did -1 to assume that they continuously are starting to lose revenue. I know it's 0.56. So I did -1 in revenue, 0, and then 3 on the aggressive side, just to see if they can continue to keep growing. But I'm interested to see what happens if they eventually lose revenue over the next 10 years. Profit margin, I kind of kept everything kosher, kept everything the same, going 18 to 19%, as well as their free cash flow margin, same thing, and the numbers that I know they can potentially hit. PE ratio and price to free cash flow, 14, 16, 18, desired return, lucky number 13. And what we'll do is we'll calculate this and see where this stands. If you're liking the video so far, folks, I do ask you, hit that like button, hit that subscribe button for more videos like this. I post Monday, Wednesdays, and Fridays stock analysis videos, as well as, if you like, follow me on Instagram, LeoDeLeo94. I usually post updates what's going on with the software and stuff like that. And if you want to peek into my personal life, if you're into that kind of thing. Anyways, current price is $64.38. Average calculation comes out to be $21.91. On our low end, $15.74. On our high end, $30.28. And in the middle, $19.72. Probably the year that Warren Buffett bought this company. It's trading a little bit steep for what you're getting. I don't think it's going to be going away for a long while. However, at the current point in time, it is an overvalued company, and the debt scares me. The amount of money that we're putting to our dividends scare me, as well as the slight decrease in revenue that may be more evident as time goes on. And as we near a recession, folks, this might be one of those businesses that may be hit. So just be mindful with this one. It's been on a little bit of a run. It doesn't mean that it's a buy. Remember, we have to do more due diligence. However, we have to understand, why are these companies going up in price? Why is the stock price going up in price or going down in price? And if it's justified. That's the main thing that we're trying to do here, folks. That's the mystery we're trying to solve. And in the case of Coca-Cola, I don't think it's worthy of the $64 price. It may be in this $30 range. However, granted, if we see more of a revenue decrease, and let's say nothing happens with revenue, it may be in this 20 mark. It may be around there. Those are my opinions. Let me know what you think. Write a comment down below of a company that you want to see evaluated. More things are on the way, folks. I didn't showcase the other features, but we have our cash flow statements, as well as our balance sheets and income statements, as well as the charts section of the software. We're able to visually see what is going on with this company and see how they perform against SPY, and see all this lovely information. So, if you want to get your hands on this software, folks, stay tuned. subscribe, and I'll let you know when it drops. Follow me on Instagram, follow me on TikTok. All that fun stuff is going to be found down in the description box below. A community page will be coming along so we can all discuss and have ideas. Write a company you want to see analyzed in the comment section down below in this video. And yeah, I'll stop rambling. That's the video. That's Coca-Cola. To my American friends that all watch my videos, much love. Enjoy your 4th of July. Hopefully this video was entertaining. And if you found it insightful, share it with a friend that may want this information if they're thinking about buying this company, or they want to learn how to develop a proper investing process. So folks, with that in mind, I'll see you in the next one.